CTD has two divisions, FD and TM. FD is an iron foundry division which produces molding that have a limited external market and are also transferred to TM division. TM uses the moldings to produce a piece of agricultural equipment called TX, which is sold externally. Each TX requires one molding. Both divisions produce only one type of product. The performance of each divisional manager is evaluated individually on the basis of residual income. So it is saying the cost of capital is 12% and cost of capital is 12% and if their own target residual income is achieved, each division manager is awarded a bonus equal to 5% of his or her residual income, and all bonuses are paid out of head office profits. So this is the relevant information. What we need to read is variable production overheads of TX include the cost of an FD molding. Okay. So what is the first part? Calculate the bonus of each divisional manager would have received under the current transfer pricing policy and discuss any implication that the current performance evaluation system may have for each divisions and for the company as a whole. Both division managers want to achieve their respective residual income and so the maximum transfer price per unit that the division manager of TM division would pay in order to achieve and the minimum transfer price unit the division manager of FD division would accept. So this is with respect to the target residual income target which they need to achieve. Alright, so CTD A part it is asking us to calculate the sales revenue. Now FD and TM. I get confused. So let me write TM over here and FD over here. External sales and internal sales. External sales, how much TM has made external sales of 500 and the maximum capacity of the external sales are 15,000, so 500 into 15, 500 into 15,000, it's 7,500 and for FD it's how much are the external sales? 5,000, so 5,000 into 80 divided by 1,000, that is 400, right? Now FD is making some internal transfer and the internal transfer price is not given to us and we'll have to calculate. It is given that the total cost of production plus 10%. So what is the total cost of production? 40 plus 20 is the total cost of production, that is 60, and we'll add 10% to it, so it will be 66 is our transfer price. So internal sales are 5,000, I believe. No, that's our external. So internal are what? Internal are 15,000 only, right? So 15,000 into 66, that is 990. So my total sales revenue is 7,500. 400 plus 990, that is 1390. Now comes my cost. Cost is what? Variable cost of production 366. 366 includes the purchases made by made from FD. So 366 into 1,50,000. Not 1,50,000, it's 15,000. So it will be 5490. I will term it as what? Purchase cost or production cost? I will variable production cost. So this is the variable cost variable, right? Let me write it clearly. Variable cost, that is the production cost. Production cost is what? 366 into 15,000, that is 5490. Okay, and what's the production cost for FD? Production cost for FD is 40 into 20,000, 800. Then what else is variable cost? Variable administration cost, that is 25 into 15,000. And for this it is 4. There is a note given that external sales only for molding incur a variable selling and distribution of 4 unit. So this is only for external sales. Variable and selling and distribution by FD is for external sales. So I'll have to apply 4 into what is the external sales? 5,000. So 4 into 5,000, that is 20. So this is my okay, sorry, I'm not doing it right now, and I'm not doing selling and distribution. I was calculating the product. Let me see, what did I calculate? Yeah, okay, yeah, I've done correctly. So the variable cost is done. Now I will concentrate on fixed cost. Fixed cost related to production is 60 into 15,000, it's 900. Production cost is 900, and then production cost is 900, and for administration also it will be, I guess, 25 into 15,000, that is 375 for administration. It's 375. Now let's come to division FD. FD now, fixed cost is 20 into 20,000, that is 400, and 4 into 20,000, that is 80. Now my total cost is 5490 plus 375 plus 900 plus 375, that is 360, and the total cost is 800 plus 20 plus 400 plus 80, which is 1300. It is giving me a profit of 90. Now how much was the capital employed? Capital employed was 7,50,000. So what is the cost of capital? 12%. 12% of 1.5 million. It's 180. And for this it was 7,50,000. So 12% of 7,50,000. 7,50,000 ka 12%, it's 90. Hence the residual income is 1,80,000 and this is 0. So the target RI was, the target residual income was 105 and 85. 105 and 85. So here I can see that the target has been achieved. Now if the target has been achieved, what was it, how the bonus had to be calculated? If the own target of residual income is achieved, each divisional manager is awarded a bonus of 5% of his or her residual income. So the bonus earned is 5% of 180, that is 9, and over here it's nil. Now rest of the part is discursive and we can do it later. And let's jump on to part B. Part B, it says that both divisional managers want to achieve their respective residual income targets based on the budgeted figures. So the maximum transfer price per unit. So if in case of TM division, let me talk about TM division. Which division is this? TM division, right? So in case of TM division, what maximum transfer price TM division would pay? First of all, how much the target is over and underachieved target. Let me write it clearly. Over or under achieved target. So overachievement of the target is 105 by 18 minus 180, that is 75,000. This is overachieved. Okay, this is overachieved. So I'm writing plus or any sign you can write. If I'm writing it in positive, I think it is overachievement, and it has not achieved, then it will have to this is overachieved. I'll write it over here, overachieved by 75,000 and underachieved. Underachieved by how much? 85, right? So if the target is overachieved by 75, what is the maximum transfer price it will have to accept? That is fine that it has accepted, it has overachieved, but over here there is no target achieved, right? Therefore 85,000 will have to be added, right? So this can be for both B and C. I think by this calculation we can do B plus C part together. So I will say that if I am wanting to meet my residual income, then what is my transfer price? Over here it has already met, TM has already met the transfer price, the residual income target, but FD has not met. So I will have to increase or I will have to increase my income by 85,000. if I increase my income by 85,000, so per unit, the transfer price is always calculated per unit wise, right? So what will be the per unit income which FD will have to, which FD will have to generate? 85,000 divided by 15,000, that is 5.6. So 5.67 is the additional revenue that FD should have, included in its transfer price, so that it could meet its target residual income. Now, why it couldn't do that? Is there any reason? Let's read the question. FD is an iron factory division which produces molding that has a limited external sales and are also transferred to TM. TM uses the moldings to produce a price of agriculture called TX, and which is sold. Each TX requires one molding. Both divisions produces only one type of product. Performance of each divisional manager. Okay, nothing has been mentioned, but again, I would like to say that it's very clear. If the question is asking that both the division managers want to achieve the residual income target, so in case of TM, I do not need to worry much, because the target has already been achieved. But if both the managers want to achieve the residual income target, that means 85,000 will have to be the income, which extra income that FD will have to generate or earn to achieve its minimum residual income target, right? So if FD has to achieve that target, it will have to increase its revenue also by 85,000. So ideally the income earned should have been plus 80, should have been added 85,000 or increased by 85,000, right? इन हिंदी आई वुड से, अगर उसको एफडी ने इनकम कुछ जनरेट ही नहीं करी, राइट, रेजिडुअल इनकम को जनरेट ही नहीं करी, वो ज़ीरो है, सो उसे टारगेट अचीव करने के लिए इट विल हैव टू इंक्रीज इट्स इनकम बाय 85,000. So by 85,000, how much transfer price it needs to earn? It needs to charge. So the internal transfers being made by FD is 15,000, and so the increase in the internal transfer price would be 85,000 by 15,000, which is 5.61. So the transfer price is what? 66 plus 5.67. So 66 plus 5.67 is the transfer price which FD should have charged to TM, right? So I have done the second part. Now maximum, this is the minimum, right? Maximum, what is the maximum transfer price per unit that divisional TM would have to pay? Since it has already met the target, it does not need to increase its profits, but it can decline its profit, right? It can decline its profit. Why will it decline its profit? It has already achieved, right? But why will it decline its profit? See, if the transfer price is increased by FD, so certain amount of residual income for TM would get declined. So what is the maximum extent to which TM can accept that decline? That decline can be up to 75,000 only. Okay, so it can accept a decline of 75,000, and per unit cost would be how much? 75,000 divided by 15,000. So it's 5. Okay, it's 5. And so in this case, I would say that the transfer price is what? The transfer price should have been paid by TM would be 71. So why transfer price would increase for TM as well? Because because the income would get declined by 75%, 75,000. And why that income is getting declined? Because the transfer price is getting increased, right? So this is the maximum increase which TM can accept, and this is the minimum price which FD should charge to TM.